Imagine this. You find the perfect home, the price is right, the neighborhood is amazing, and you can already picture yourself having morning coffee in that beautiful kitchen. But then, bam, you hit a wall, the mortgage process. The lender tells you that you don't qualify, or you get blindsided by hidden fees. Sound familiar? Stop right there. Today, we're exposing the biggest mortgage myths that could be costing you tens of thousands of dollars and keeping you from your dream home. And if you're thinking you need 20% down or that your credit score has to be perfect, drop a comment below right now, because we're about to shatter those myths. So let's dive right in. Myth number one, you need a 20% down payment. First things first, you do not need 20% down to buy a house. If you're sitting there thinking, I'll never be able to save up that much, you're not alone. Most people assume that 20% is the magic number because they don't want to pay PMI, or what's called private mortgage insurance. But here's the reality. FHA loans let you buy with as little as 3.5% down. VA loans for veterans and active military require 0% down. Conventional loans can be as low as 3% down. So let's do the math. And I'm going to use some Bay Area prices. So a $1.2 million home in the Bay Area with 10% down means you're keeping $120,000 in the bank. Now, let's say that home appreciates 10% in the next year. That's $120,000 in equity. Instead of waiting years to save 20%, you could have bought now and gained that wealth sooner. And PMI, well, it's just renting the money until you refinance. I have clients who buy with 10% down, and within a year or two, they refinance and drop the PMI entirely. Drop a comment below. Do you think you need 20% down? Let me know below. Myth number two, the lowest interest rate is always the best deal. This is where people get scammed all the time. You see a crazy low rate and you think, oh, that's amazing. But then you look closer and you see a huge APR difference. That's because brokers and banks love to sneak in points to buy down a rate, so they make it look lower. Now here's a trick. Always check the APR. If the APR is much higher than the quoted rate, that means there are extra fees buried within that loan. Let's break this down. Rate is what you're paying on the loan. APR is the real cost of your loan that includes all the fees. For example, if a lender offers you a 6.5% interest rate with an APR of 7.2, that means you're paying points up front, literally throwing your cash at the bank. What should you do? Well, ask for a raw rate sheet so you see what the rates are available. Check the APR before signing anything. Always compare a 0-point option to see what the true cost is. Pro tip, if you're working with me, I always show my clients the rate sheet up front so they know there's no hidden BS. Myth number three, permanent rate buy downs are always a good idea. Here's the deal. Buying down your rate permanently is like prepaying interest. You're throwing money at the bank that you'll never get back. But with a temporary buy down, you put your money into an escrow bucket, and if you refinance before that time is up, well, you get every single dollar back. For example, a 2-1 buy down lets you pay 2% lower in year one and 1% lower in year two. Now, if you refinance before year two ends, you get the unused subsidy refunded right back at you. For a $1.2 million loan, this could mean getting $10,000 back if you refi early. Myth number four, don't get a gift for your down payment. This is a huge mistake. If you're getting a gift from family, do not just deposit into your account. The bank will source every single penny and ask you for 2 months of bank statements from the person who gave you the money, as well as yourself. Instead, have the person wire it directly to escrow. It's not going to trigger any extra documentation requirements, and it makes your life a lot easier. Myth number five, you can't qualify if you had a foreclosure or a bankruptcy. Wrong. You can still buy a home after a bankruptcy or a foreclosure. FHA loans allow you to buy 2 years after a bankruptcy or simply 3 years after a foreclosure. Conventional loans let you buy 4 years after bankruptcy. So, if you thought you were locked out forever, think again. Still skeptical? Let's dive even deeper into these mortgage myths. If you know someone who needs to hear this, send this to them right away. Next, check my next video on mortgage hacks the banks don't want you to know, where I break down even more insider tips. Click here, right here, to watch. See you guys.